Imagine this. You wake up on a Monday morning, you go to work, you're a stockbroker on Wall Street. It's 1987, you're wearing a sharp suit, your hair is perfect, life's good. The market has been going up for 5 straight years. Everyone you know is making money. Your clients are happy, your boss is happy, you're happy, and then in a single day, the entire market drops 22%. To put that in perspective, the worst day of the 2008 financial crisis, the market dropped about 7%. The crash that kicked off the Great Depression in 1929, about 12%. Black Monday, October 19th, 1987, was nearly double that. In one day, $500 billion disappeared. Here's the strange part. Nobody actually knows why it happened. There was no war, no bank collapse, no major news event that morning. The economy was doing fine. So how does the biggest one-day crash in stock market history just happen? The answer is pretty wild. It wasn't really the economy that crashed, it was the technology. And the people running the show had no idea that their machines were about to do that. So to understand Black Monday, you have to understand what was new in 1987. Computers. Wall Street had just started using them in a big way. It was the first time ever you didn't need a human to make a trade. A computer program could do it for you. It was faster, it was cheaper, it was around the clock, and one of the most popular new programs was something called portfolio insurance. The idea sounds smart. Big investors, like pension funds and banks, had billions of dollars in the market. They were nervous, understandably, about losing it all in a crash. So a few clever guys at a company in California came up with a fix. They wrote a computer program that would protect your money automatically. Here's how it worked. The program watched the market all day. If stocks started going down, the program would automatically sell some of your investments to limit your losses. The further the market dropped, the more it would sell. The pitch was pretty simple. You could stop worrying about a crash. The computer would handle it for you. By 1987, around $60 billion was being managed by these portfolio insurance companies. That was a massive, big chunk of the market. But here's the thing nobody thought about. What happens when everyone has the same program? The week before Black Monday, the market had a few rough days. Nothing crazy, just a normal pullback. Stocks went down a little on Wednesday, a little more on Thursday, and then on Friday, October 16th, they fell harder. The market dropped 4.6% that day, which at the time was one of the biggest single-day drops in history. Over the weekend, the portfolio insurance computers ran their math, and they all came to the same conclusion. When the market opens Monday morning, we need to sell a lot. Now, here's where it still gets even crazier. Monday morning arrives, the opening bell rings, and the computers start dumping stocks, billions of dollars worth, all at the same time, all for the same reason. The market drops hard. Within the first hour, prices are tumbling. And as they tumble, the portfolio insurance programs do exactly what they were designed to do. They sell more, which drives prices down further, which triggers more selling, which drives prices down further. This is what's called a feedback loop. The computers were supposed to protect investors from a crash. Instead, they literally just caused one. They just crashed themselves. And once it started, no one could stop it. So now you might be thinking, well, couldn't the humans just turn off the computers? Couldn't somebody pick up a phone, call the trading floor, and yell, "Stop selling, everyone"? Here's the nightmare part. They actually tried. It didn't work. The phone lines on Wall Street that day were completely overwhelmed. Traders couldn't get through to their offices. Brokers couldn't reach their clients. The systems that were supposed to handle trades were so backed up that orders placed in the morning weren't getting processed until hours later. If you are a regular person who owns stocks and you called your broker to sell, you might have waited on hold for an hour. By the time you got through, the price had already dropped 10%. By the time your trade actually went through, it had dropped another 10%. Some stocks couldn't even be traded at all. The systems just froze. Imagine trying to sell your house while the price is dropping every minute and the realtor isn't picking up the phone. That was Black Monday. The famous quote from a trader that day was that he watched his screen and saw numbers he didn't believe were possible. The technology that was supposed to make trading faster, smarter, and safer had done the opposite. It turned a bad day into the worst day in stock market history. By the end of the day, the Dow Jones had lost 508 points. That was 22.6% of its total value gone in one trading session. Around the world, it was even worse. The crash spread overnight to other countries. Australia's market dropped 41% over the next few weeks. Hong Kong shut its market down for 4 days to try to stop the bleeding. London dropped 26%. And here's the strangest part of the whole story. Within 2 years, the US stock market had completely recovered. By 1989, it was back to where it had been before the crash. Nobody went to jail, no banks failed, there was no recession. Black Monday didn't break the economy because the economy was fine. Black Monday broke the systems we used to trade the economy. So what did Wall Street do about it? Two big things. First, they created what are called circuit breakers. There are rules that automatically pause trading if the market drops too much in one day. So today, if the stock market falls 7% in a single day, all trading stops for 15 minutes to let everyone catch their breath. If it falls 13%, it stops again. If it falls 20%, the whole market closes for the rest of the day. These rules exist because of Black Monday. Second, they rebuilt the technology. The phone-based systems and early computer programs of 1987 are obviously long gone. Today's markets are run by faster, smarter, more connected machines. But here's the question that still keeps Wall Street up at night. Did they actually fix the problem? Or did they just make it bigger? Today, computers don't just handle some of the trading, they handle all of it. By some estimates, 70% of stock trades are now made by algorithms with no humans involved. Programs talking to programs, machines to reacting to machines. And the speed has gone from seconds in 1987 to fractions of a second today. In 2010, something called the flash crash happened. The market dropped almost 1,000 points in minutes, then bounced right back. What was the cause of that? Algorithms gone haywire, just like Black Monday, but faster. The story of Black Monday isn't really about 1987. It's about what happens when humans build a system they don't fully understand and then trust it to run on its own. Remind you of anything? The portfolio insurance programs were designed by smart people. They were tested, they worked in the simulations, but nobody thought to ask the simple question: what happens if everyone has the same program at the same time? Today, the algorithms running Wall Street are 1,000 times more complex than the ones that crashed the market in 1987. They're written by people who barely understand each other's code. They react in milliseconds to events humans can't even see, and they're managing trillions of dollars. The next Black Monday isn't a question of if, it's a question of when. And when it comes, it'll probably happen so fast that by the time anyone notices, the damage is already going to be done. The lesson of 1987 wasn't that computers are bad. The lesson was that any system, no matter how smart, can fail in ways you didn't predict. The traders in their sharp suits that morning learned it the hard way. The machines they trusted to protect them were the same machines that destroyed them. If you like this video and want to dive deeper into the strange world of market crashes and the systems behind them, check out the resources I've linked in the descriptions. Hit subscribe if you want to hear more stories like this one, so I'll catch you in the next video.